Hello and welcome to this panel on central bank digital currencies and the international monetary system. Today's discussion is a part of the New Economy Forum, Fintech Exchange, a series of events in the run-up to the IMF's annual meetings 2021. In this panel, we will be discussing potential implications of the emergence of central bank digital currencies, or CBDCs as we call them, on the international monetary and financial system. I'm joined by three distinguished experts: Markus Brunnermeier from Princeton University, Nihan Narula from the MIT, Massachusetts Institute of Technology, and Hyun Song Shin from the Bank of International Settlements. And thank you very much for joining us. We might be on the cusp of a revolution in the global financial and monetary system. This is due to the advent of digital money. CBDCs are a new form of central bank money accessible to the public. It may be the new frontier in the evolution of the international monetary and financial system. And the IMF aims to inform the policy debate through independent analysis. We also advise countries and help them evaluate policies relating to CBDCs. This summer, we published a policy paper representing the IMF strategy to step up surveillance and capacity development work related to digital money and strengthen the analytical foundations in this area. In all these efforts, we engage and collaborate closely with other international institutions, standard setters, the academic community, and other stakeholders. The distinguished panel we have assembled here is a case in point. The three panelists bring together different but complementary perspectives. They have all made important contributions to our thinking about these complex issues, and our conversation today is structured to discuss two interrelated topics. The first is whether cross-border availability of CBDCs, whether they would improve the stability of the international monetary and financial system. As you can imagine, this is critical for the fund. And the second topic is whether CBDCs will lead to a reconfiguration of international currencies and the global financial safety net. So we will start with the first topic, basically the implications of CBDCs on the stability of the global monetary and financial system. For emerging market economies and developing countries, especially those with weaker fundamentals and policy records, there's a concern that CBDCs would further exacerbate currency substitution, limit the policy space, and potentially increase the likelihood of currency runs or runs on the domestic financial systems. And capital flows are fundamental, of course, for the global transfer of savings towards productive investments, but they can also be subject to excessive volatility. So it's extremely important to understand what impact CBDCs could have on capital flows and on their volatility. And this is a complex question. We could see faster contagion and capital flow reversals, but CBDCs may also create new global safe assets. So it's really important that we look carefully and analyze different perspectives. And if these assets, these new assets, especially if they are uncorrelated, they could improve risk sharing and stability of the global financial system. At the same time, capital account restrictions may become harder or easier to implement depending on the design of digital money and regulations. So the responses to these questions are likely to depend on the design and features of the CBDCs. And from a policy perspective, it is important to think through carefully what the architecture and design allow CBDCs and whether they can improve global financial stability. So let's start the discussion with our first panelist, Markus Brunnermeier, professor from Princeton University. Markus's research focuses on international financial markets and the macroeconomy. Markus has made very important contributions. For example, he has coined the concept of digital currency areas, where the use of currency is linked to a particular digital network rather than a specific country. So Markus, would CBDCs increase currency substitution and financial stability risks, especially in countries with weaker economic fundamentals? How should we think through these issues?
Thanks a lot, Sheila. It's a pleasure to be with you and to have the opportunity to talk here at this forum. So I would like to change the perspective a little bit. So there's a lot of debate, if we introduce CBDC, how will it change the stability of the international monetary system if we introduce it now? But I think what's really important to understand is that we will change the system anyway. So we should actually say what happens if we have a new system and we have it with CBDC or not with CBDC, and how will the new world look like? So we will have a new world where you can much more easily switch across currencies. So the switching costs will decline. And the way it will be in the future is that you can just go in a store and in the augmented reality glasses from Google or Apple or whatever, you can actually then see already the favorite currency, the prices in your favorite currency. So things will change a lot. So right now, we all use, essentially as a unit of account, we use the currency we're most familiar with. In the future, the switching from one currency to another currency will be much more easy, and it will also, the lock-in effects we have right now, the frictions we have right now will go away. It's a little bit like if you look at translation software. Right now, we all speak in the same language in the same country, but in the future, we can just communicate with different languages, and then there's a translation software translating everything. So we are much less locked in a common language within a country. That will be the case. We'll be much less locked in a particular currency. Now, in such a world, things will be much faster moving, and everything will be more dramatically switching back and forth, and it also limits the policy space for individual central banks or also from the fiscal side. So the policy space is much more limited, and that's why the CBDC in this picture comes in. It can be actually a stabilizing force. And let me just go to financial stability issues a little bit. So in a sense, there's always the danger, once you have CBDC, it is the case that bank runs might be more likely because it's so easy to run from a particular bank into central bank digital currency. But you can also easily run into another bank. And so why should you run in a particular CBDC compared to a very solid other bank? And I think what the advantage is, if people run into CBDC, actually they run into the central bank of the same country, and the central bank of the country can then channel back the funds back to this particular bank. If the central bank views this bank solvent, then all the bank run will not occur. If you don't have CBDC, then people might run into another currency because it's not much more easy to run in another currency. And then the system, the money leaves the country. And that's actually, in my view, much more dangerous than having a bank run on a particular institution where you can channel it back. Once you have a run away from a currency into another currency, it runs outside of the central bank of this particular central bank's universe, and it's much easier to contain these dangers. So in particular, smaller emerging and developing economies, they will be threatened much more in the future by currency runs than by bank runs. And hence, having CBDC actually will channel, gives another outlet, gives another safe haven or safe asset, as you called, to run into. And that grants the central bank then the possibility to channel it back and stabilize certain banks, which they view as solvent, others perhaps not, if they are insolvent. And that's very, very important. But the key here is the design of the CBDC to make it stable. And for example, the big design issues are, can non-residents hold CBDC or not? So that's a design issue for a country, but also for another country where you can run into something. And will the other country, the foreign country, make non-residents allowed to hold their CBDCs? You can run into these other countries. And there will be competition across CBDCs, much more forceful competitions, and with respect to private currencies, stable coins. And if there's more regulation on these stable coins, actually it will be the case that then paradoxically, there will be seen as a better substitute for the official currencies. So the more regulation there is on the stable coins, the more competitive there will be, and the more likely will be a run from a smaller emerging economies into these stable coins, and potentially destabilizing then these countries if they don't have an alternative, if they don't compete with their own solid CBDC arrangement at home.
Very good points, Marcus, and really I like the analogy to the Google translation. Hopefully we don't get lost in translation, and what you say very much makes sense in terms of the need for regulations and in terms of the good design of the CBDCs to think through these possible transmission channels and try to address them. And that provides a very good segue to our second panelist, Neha Nirula, who is the director of the Digital Currency Initiative at MIT. She has been involved in a research collaboration with the Federal Reserve Bank of Boston on Project Hamilton, aiming to understand the technology trade-offs involved in a hypothetical digital dollar. And so, Neha, please tell us, how should the CBDCs be designed to help improve the stability of the global system along the lines of some of the issues that Marcus raised as concerns?
Yeah, well, thank you. First of all, thank you for having me. It's an honor to be here. I think we need to take a step back and think about CBDCs in the larger context of innovations in technology and finance. So CBDCs are one way of possibly improving payments and financial flows, including financial stability, but they're not the only way. And it's not an either-or situation. There will be many solutions deployed in tandem. For example, to improve inclusion, faster payment systems might help lower costs, or there might be regulation to improve access to free or low-cost digital financial services. One thing missing from the discourse is a very rigorous study of how these different solutions might compare and contrast in achieving our goals, like stability. And part of the reason this comparison is missing is because one cannot simply refer to CBDC as a single coherent product or tool. Everyone who does make assumptions on how a hypothetical CBDC might work is making assumptions, and these details matter quite a bit to how the CBDC is used. A specific design's efficacy to achieve its goals depends very much on specifics, and I'm sure that these decisions will be very different in different jurisdictions as well. So let's consider multiple solutions, many of which might be deployed in a complementary fashion, including a range of approaches for how CBDCs might be designed. And we can think of these designs on a spectrum, from approaches that differ slightly from our existing system to designs that are a bit more radical. So, for example, on the end of designs that are sort of incremental changes over our existing system, we can think about regulation that might require commercial banks to provide free accounts, or that might actually give more institutions, more financial institutions, access to a central bank's balance sheet. From there, we move down the spectrum to things like tokenized bank accounts, which is essentially what our stablecoins are sort of going down the path towards becoming. And designs further away in the realm of central bank digital currency could take on many forms. And one of those forms is something that we call digital cash. So something that is very accessible, very easy to use, and is peer-to-peer. It can be transmitted person to person. Now, with all of these designs, it's important to evaluate trade-offs. And an example here's an example of a factor that is very important to think about, that of access. So who can access the CBDC, but more importantly, not just what the rules are or what we say about who can access the CBDC, but exactly how that access is mediated. So at a very fine-grained level, a very technical level, who actually is in the middle when a transaction happens on a CBDC? Who can prevent a transaction from happening or make it very difficult for an individual to make a payment in a CBDC? Because no matter what the rules say, people are going to use this in ways that we don't expect. And related to that question is what is required to onboard onto a CBDC. So many designs assume some form of digital identity, which in most of the world does not yet exist. And in many contexts, requiring some form of digital identity to use a CBDC could leave out the most economically disadvantaged. So there's still much work to be done here. In addition to that, lowering the barrier to transacting introduces security risks. So the more access there is, the more people who can access the system, the more risk of malicious actors accessing the system. So, if we want to achieve these goals of financial inclusion, we have to think about how can we design tools to mitigate entry into the CBDC without necessarily requiring high fees or strong forms of identity. Another important area to think about, another factor of design, is that of data visibility and retention. If privacy from the central bank itself is not taken seriously as a first-order concern, then the door is open for rogue states to use CBDC as a form of monitoring and enforcement against their own citizens. And what's very interesting here, I think, is that first movers have inordinate influence in setting norms and standards. So China's ECNY, for example, is already setting a specific specific type of expectation, that the central bank will not store user data, but that data, which is stored at commercial banks, can easily be aggregated and could be accessed by the government. It's interesting to note as well that designs which really reduce the amount of data stored at the central bank introduce other risks in terms of recovery and auditing and also access to the system. I want to point out that these questions that I've just raised are not actually connected to the typical debate we've been having about whether the data model is tokens or accounts or whether you use DLT or not. I think we've really gone beyond this simplistic framing. And I'll also add that if CBDC is designed to look very close to the system we have today, where perhaps the only notable difference is that it's a central bank liability, it's hard to see how there'll be as much potential for impact. If the public still has to conduct digital payments primarily through commercial banks and commercial bank accounts, it seems like it would be very close to the system of walled gardens that we have today. We have an opportunity to create something better with 24/7 availability, strong data privacy, secure offline transactions, and a platform for innovation with programmable money. So designing a new system, keeping in mind our public policy goals, might look quite different than what we have today. And that implies there'll be a greater likelihood of effects, including risks, but also a greater likelihood of achieving benefit. And I want to point out that even if we're unsure of what effects a new CBD design might have, not doing anything at all might affect the international monetary and financial system even more. Money is changing, technology is changing, and it's going to move forward whether or not central banks consider also evolving their system. So we have to evolve with it.
Thank you. These are excellent comments, both technical as well as what you alluded to at the end, which is this is going to happen, and it's better to coordinate and innovate in a way which makes the most use of them rather than trying to prevent this. The very important points, and I would like to come back to some of the key issues that you raised, but we now have Hyun Song-shin, who joined us. He had some technical issues, but now he's on board, which is great. Hyun is the economic advisor and head of research at the Bank for International Settlements, had a very distinguished academic career, and is a thought leader in the areas of banking, international finance, and monetary economics, and is currently leading the research program on digital innovation and the financial system, including CBDCs. So Hyun, you just joined us. I wanted to ask you, building up on what Marcus said and what we heard from Niha just now, what do you think would be the effects of CBDCs on capital flows and volatility, and ultimately the economic impact? And how should we think about some of the issues that Niha raised in terms of the design features that would allow us to address these risks?
Absolutely. Thank you, Jayla. Thanks for the invitation to join this great panel. I think the design issues are absolutely key in how they will function and what kind of effects they will have on the economy. I think broadly speaking, there are two forks in the road, if you like, in the design of a CBDC. One fork is the choice of whether it's the operational architecture. Do you have a central intermediary, namely the central bank, that keeps track of the transactions and ensures integrity and finality, or is it based on a decentralized governance system based on DLT or blockchain, if you like, where the validity of payments depends on achieving consensus among network participants? Now, and the second fork in the road, perhaps even more important, is whether the access happens around the verification of personal identity, so some notion of ID being central, or whether it's done through, like cash, some verification of the validity of the object being traded, or with, let's say, public key cryptography, as is done with Bitcoin. And I think by now central banks have a pretty good idea of the kinds of design that will work best. And to cut a long story short, I think we're coming to the view that some combination of a verifiable ID combined with certainly for retail CBDC, more of a centralized ledger that can really handle the volume of payments that you would expect with a general purpose CBDC. It's of course different for wholesale, where there are fewer market participants, although the amounts are larger. So when we think about the implications of CBDC for capital flows, for currency substitution, and international spillovers, the idea of CBDCs being analogous to wads of cash in briefcases, circulating in a black market, that's probably not the right analogy when we think about CBDCs, because most realistic designs rely on a two-tier system where there is good onboarding and due diligence based on personal ID. And what that means is that the central banks will have a say on who has access to the CBDC, although there are some variations in the design as to whether the central bank keeps a copy of the ledger centrally. But irrespective of that, the central bank will have some say on who has access. And so the use of one country CBDC outside that jurisdiction will, to a large extent, be under the control of the central bank. And I think what that means is monetary cooperation will be key. Some notion of the mutual recognition of digital ID is going to be key for cross-border payments. But I think the kinds of extreme cases of currency substitution, whereby you can have a foreign CBDC encroach and actually displace your home currency, I think that's probably not the right kind of picture.
Thanks for this, Hyun. I want to turn back to Neha and see if she has any comments on what we just heard from Hyun in terms of the most likely system that the central banks have been discussing, both in terms of the operational architecture and the access. Just to get your views, Neha, on this quickly before we move to the second broad topic.
Certainly, sure. So I think there's probably what we hope will happen, and then there's reality, which might end up being a bit different than what we expect. I do think it's challenging to rely on notions of digital identity, especially when most of the world does not necessarily have a strong digital identity or inclusive digital identity framework implemented. And in the places in the world where it is implemented, we're still understanding what type of effect it has on who is included and who is not included. So I think that this will probably be pretty challenging in practice, and that we're going to have to look very carefully at how digital identity is implemented, how digital identity requirements might affect financial inclusion in particular, given even in the United States, how many people do not have certain forms of identity that we might expect them to have. And in addition to that, if we are going down a path that considers things like strong digital identity, how that data is stored, who has access to that data, what happens when those data stores are breached, because it will happen. These are sort of very important practical considerations to consider. And so I think we probably need to go further down the path of implementation and design in order to understand if these high-level approaches are going to be viable in practice.
Very good point, and I know our colleagues across the street, World Bank, has been working on ID for development, and there was very good collaboration both with the private sector and the public sector to address some of the issues you just mentioned, because as we know, some countries have made progress, like India with Aadhaar and so on, but then there are many parts of the world that do not have a digital ID in place. So really, as you say, this will have implications in terms of inclusion within and across countries. So let's talk about the second broad topic, and that's basically whether CBDCs would lead to a reconfiguration of the international currencies and the global financial safety net. For us, as a key part at the center of the global financial safety net, this is of course very important. It has been argued that introducing a CBDC sooner rather than later could give rise to a significant first mover advantage to its issuer. You just mentioned it as well, Neha. Moreover, CBDC competition may differ from traditional currency competition, as Kuhn mentioned, by differentiating along associated networks and users rather than being based on macroeconomic performance. So this, of course, would alter the traditional drivers of international currency configurations. And for central banks that decide to use CBDCs, this may cause, in some cases, help their currencies to internationalize or achieve reserve currency status, and could help new currencies overcome some of the advantages of incumbent dominant currencies. So intense competition between a few major CBDCs could provide the backdrop of an emergence of a multilateral, multipolar world. And throughout history, transitions from one dominant international currency to another year took anywhere from several years to many decades. And the transition process has often led to a lot of uncertainty, sometimes turmoil, and even crisis. So how would the transition from the current international monetary and financial system without CBDCs would look like in the future with CBDCs? So what are the opportunities we face? What are the risks? And when a few CBDCs become widely adopted, how do we make sure that coordination can be in place to make sure that we don't have instability as investors substitute from one reserve asset to another, as we just discussed? So let's talk about how dominant CBDCs, multiple dominant CBDCs could fragment established funding markets and official liquidity support mechanisms. And I would like each of your views on what are the factors that we should be thinking about as we adopt CBDCs, and how do we make sure that we avoid a multipolar international monetary and financial system, and how do we manage the transition? So let's start with Marcus, please, and then I'd like to go to Niha and Huyen.
Thanks, Sheila. That's a fascinating question. I think it refers also to this concept of digital dollarization or reminization or eurodization. And I think what's really important here is to say you can have an offensive move or a defensive move. And then, for example, whether you design CBDCs to be allowed by non-residents or not, as was mentioned before, how you can onboard on CBDCs is very crucial, but it's not your own CBDC, but it's a foreign CBDC which can actually change that. And I think there will be many new digital currency areas evolving. There will be some private and some will be public. And I think rather than the CBDC itself, which I think is very important, but the private institutions, the private currencies, which rely on a backing by CBDC will be more important. So rather than focusing only on CBDC, I think what's really important to establish a new global currency is the global lender of last resort feature. To what extent does the central bank offer directly or indirectly a lender of last resort feature to private currencies, which are then denominated in this particular unit of account? So if you want to maintain monetary sovereignty, it's all about maintaining the unit of account role of money. And the unit of account role of money, you can defend it by having a more powerful lender of last resort feature. So people and banks will then issue deposits, or private entities, could be big tech companies, issue deposits in form of this unit of account if they know there's more regulation, there's smarter regulation, and there will be some backing in form of a lender of last resort. Of course, the central bank has to take a certain counterparty risk, but if there's smart regulation, I think that currency will have an edge over the other currencies. So paradoxically, if you have more regulation or smarter regulation, you have a bigger chance of taking a larger share of the international capital market. So what's really required is some elasticity of the currency, also extended to the digital space as well. And CBDC will be the contributing factor, but I think it's not the decisive factor. Overall, what we will see, and you alluded to that, we will see crises becoming way faster than historically because everything will move much, much faster. And if we have to have a system, it might be useful to have CBDC because you can respond faster as well. So the private sector crisis will move faster. So you have to have a setup from the official sector, which can also respond very quickly and very fast. And then that's important to have. Whether this will be then a multipolar or a unipolar system. That still depends actually on the different regulation, but I would not only focus on CBDC. I would take a broader perspective on this because I think it's very important. The other elements are probably at least as important as the CBDC components to that. And finally, then the transition phases you mentioned, if we move to a different setting, the transition phases are always loaded with financial instability risks. And that's what we have to watch out how the transition then will happen if we make this transition. And that depends again on the ultimate policy decisions by the various countries, whether they're offensive or defensive, and how then the transition will be organized by the other countries that will be part of a multipolar arrangement if this ever happens to become this way.
Niha, over to you. Thanks, Marcus. And you mentioned more and smart regulation, that this would allow countries to have an edge over, central banks to have an edge over other currencies and be able to take larger share of the capital markets. So what do you think, Niha? How should we think about this more and smart regulation? What are other issues that you think we need to focus on?
Yeah, so I think there's two important factors to think about, and especially thinking about what we can learn from what's happened in technology in the past. The first is, as Marcus was speaking about, speed. So technology has a way of creating unforeseen side effects and changes at wide scale and with rapid speed. And we've seen examples of this, for example, in the trading world with algorithmic trading and high frequency trading, and sort of the interesting effects that speed has brought on in enabling certain risks and in those markets. The other area I think that we need to think about is standards. So we talk about the first mover advantage a lot, and it's actually very interesting because in technology, it can certainly be possible to be too early to develop a product that the world is just not ready to receive, or the infrastructure isn't in place to make that product as successful as it could be. So sometimes the first mover doesn't always win. Sometimes they're too early. But I think that it's not just about the first mover effect for adoption. It's also about the first mover effect for standards. So whoever's first out of the gate here is going to set norms and standards around around privacy, around how open the system is, and actually very detailed standards in how transactions are formatted and how they interact. And as financial institutions start onboarding onto these systems, they're going to get used to one set of standards, and it's going to be extra work to add in new sets of standards. So I think these are the really two key features to think about here. How speed and an improved speed is going to end up affecting what is usually the most cumbersome leg of a transaction, which is the cash leg of a transaction, and then standard setting and how the first mover might have an effect in setting standards and expectations.
Very, very good points. And there's a lot of debate, of course, in the international fora, at the G7, at the G20, at the BIS, of course. So Hyun, can you tell us your views on, in particular, standards and what Marcus termed as more and smart regulation?
Yeah, I think more and smart regulation is certainly going to be part of this. But let me go back to your high-level question, which is which was all about the multipolar nature of the monetary system and the emergence of vehicle currencies and so on. I think if we take a long perspective, Jayla, I think what we can see is that money, or the payment system itself, doesn't really exist in a vacuum that's separate from the underlying economic relationship. So in a way, that's a sort of fairly sort of basic point. But I think we probably underestimate the extent to which economic transactions weave this web of long-term relationships between individuals as suppliers, intermediaries, or as customers. And this web of relationships really is the underpinning for the financial system itself. And if we think about how cross-border payments actually arose, and Isabel Schnabel and I wrote a paper about cross-border payments in Europe in the 18th century, surrounding the bills of exchange. And there, the payment system was also a credit system because the bills of exchange were discounted along the chain, and they allowed merchants in the chain to finance their working capital. And deposits really came much later, as some of the merchants took in deposits to settle maturing bills. And so in this respect, the bankers of the day were also merchants, and hence the origin of the term merchant banker. So why do I point to this? I think it's important that these long-standing relationships are really important in generating that trust and if you like, the relationship-specific collateral that really underpins the fact that you can actually make promises. So just by virtue of technology, just by virtue of being able to issue a currency in digital form, of course, that's going to have an effect at the margin. But that's not going to fundamentally change, the rationale for the need to make the payments, along that chain, as it were. So I think, when we think about the global implications of the adoption of CBDCs across jurisdictions, I think the keeping pace, if you like, the financial system and the payment system keeping pace with the underlying economic transactions, this will probably be a very important part of our thinking. And clearly, being able to set standards is going to be absolutely key. And because of the coordination nature of the network nature of standards, that could take a lot longer than we may think, at least in terms of theory.
Yeah, very much so. I want to go back to one point that's raised. Marcus started talking about it, and that's we have CBDCs, but we also have other forms of digital assets, digital currencies. Some of you mentioned already the Bitcoin and so on. So I'd like to ask you each to please talk about how this of course complicates the landscape when you have other forms of stable coins or digital assets. How should we think through the interactions and transmission mechanisms that do impact both in terms of the safety and the risks and opportunities that CBDCs can provide going forward? So how should we, what are the complexities and challenges of these different let's call them assets and stable coins? Do you want to start, Hyun?
So should I jump in? Or?
Yes, please, Marcus.
So essentially it depends to what extent I can imagine that there will be a lot of private currency and coins which will be highly regulated, and then there can be to a degree convertible to CBDC. And if this is the case, you can extend the roam of your currency quite a lot. So essentially it is the interaction between private coins and CBDC which will make the whole setting different. And as I mentioned earlier, that's where the global lender of last resort comes in. Does the central bank want to do that? Want to extend some guarantee to some private coins or not? By doing so, it will, and if this stable coin is denominated in the home unit of account, it can increase its visibility, its influence at a global scale, but it also takes on some currency risk, and it takes some default risk or counterparty risk, and that's a big decision all of the various players have to make. But if you, that's for the large countries, but for the smaller countries, they can see this as a threat, and that's why they would like to design their own CBDC as a defense mechanism, and not allow their own citizens to hold these foreign stable coins, or might limit their activity in the stable coins. And I think that's where CBDC will be an important element in a bigger design issue, but it's only a small part of it, but it will be some core element where they go, this is our safety, this guarantees our unit of account, and CBDC will help us either to defend our own unit of account, or also in an offensive way go into some other countries and expand the influence of our unit of account. And that's the decision every nation has to make. And there will be new digital currency areas evolving. And as I mentioned earlier, privacy plays an important role. So if you protect certain privacy, there will be certain currencies which are very, focused on protecting privacies, and certain people will focus and like to use these particular private currencies. Others don't care so much, and they are rather have a higher return on their currency. They will go for that, and there will be some currencies focusing on the medium of exchange role and other currencies on the store of value. So there will be a lot of things, but what is then ultimately anchored to the official currencies and who will anchor them and what risk they are willing to take and how they will regulate them, that should be part of the whole picture. And that will determine then which unit of account will take a bigger role in the global scene and which one will not take a bigger role.
Very much so, and we did a survey of our member countries, and 141 countries said they're in some spectrum of either establishing or thinking about how they should position themselves vis-a-vis CBDCs. And one of the key questions, of course, was how does this fit in the broader scheme, configuration of different types of private coins versus CBDCs. So really grappling with trying to understand, as you said, what would be the implications on the lender of last resort role and regulations more broadly, implications for privacy, implications for AML, CFT, anti-money laundering, and regulations, and so on. So really complex set of issues, and what makes it also very difficult is the uncertainty, because there are different countries at different stages of the process, and that creates, of course, both coordination issues, but also difficulties in terms of design. I'd like to give the floor to Hyun and then Niha on these same issues. Over to you, Hyun.
Thank you, Jayla. Let me pick up on I think one very important theme, which is the role of CBDCs within the broad perspective of financial innovation that will benefit users. And I think we should not underestimate the huge advances we've made in the conventional payment system as well, especially through the retail fast payment system. And here, perhaps the biggest advances have been seen in the emerging markets, where they are not held back by legacy systems, where there is a great deal of impetus to these innovations. And I think India is a very good example. I mean, you mentioned Aadhaar, Jayla, the digital ID system in India, but UPI, which is the retail fast payment system, I think in many ways embodies some of the best principles of an open architecture, where if you want to be a member of the system, you have to play by the rules in terms of the interoperability requirements across different platforms. And the UPI system in India is just one example of a recent spate of retail fast payment systems that really embody the spirit. And the PIX system in Brazil is another very good example where it's been up and running since last November, but they've already signed up roughly 2/3 of the population. Less so in terms of volumes, but a very large user base. Now, why are these innovations really important? Well, I think it's because the way that it's structured, the architecture is in terms of an open architecture where there are requirements for ownership of data by the users. There are application programming interfaces that make sure that interoperability is ensured between the payment service providers. And what that means is that you achieve both preventing this walled garden phenomenon, where you have proprietary networks really dominating, while at the same time lowering costs and promoting financial inclusion. And I think it's important to note that if you have something like a retail fast payment system, you are pretty much, I would say, 70% of the way there towards a CBDC. You have a retail fast payment system. If you have a retail fast payment system, what you already have is a digital ID infrastructure that you can draw on. You have the cryptographic systems up and running that will ensure a high level of security and privacy for the individual users. And these are exactly the kind of features you will need if you want to roll out a fully fledged, CBDC that will enhance financial inclusion. Now, you're not quite there to a CBDC because it's still a two-tier system where users have claims on intermediaries rather than the central bank directly. So if you like, the leap from a retail fast payment system like PIX or UPI to a retail CBDC, that's really more of an evolutionary step rather than something which is radically different. I think we are, building on a lot of the informational infrastructure that you will need to have this open architecture. So I think, in that sense, progress has already been made, and I think the impact is already being felt. But it's a very, it's a very rich ecosystem out there with a lot of different players, jostling for attention. And I've just come from our own event on big tech in finance, and I think the entry of big techs is going to be probably the most interesting and important issue for us to ponder, as central bankers, as policymakers, in this a very important area. If the big tech is also a stable coin, with its own ecosystem, what that means is that then you could also have the ecosystem being propped up on its own money. And then you have to face these even bigger issues that Marcus knows very well about the fragmentation of the monetary system and so on. But let me just stop there, Jayla, without going on too long.
No, very, very good points, Hyun. On your last point, and linking back to what you said about the cross-border payments in Europe and the merchant bankers, I think what does big tech mean in terms of the financial sector architecture? What does it mean for the banking sector? And how would that then what would be the implications on the lender of last resort role of the central bank are a really key question. So I would really like to hear from Neha first and then turn to...
so Jayla,
go ahead.
Sorry, the video feed just cut out for a second. So I think your question was on what would the entry of big techs imply for the banking sector. Is that right?
Yes, so I was just saying that I was linking this to what you talked about earlier on the cross-border payments in Europe and merchant bankers, and that the big techs in this space, what would be the implications for the financial sector landscape, implications for commercial banks, and of course, relating to the topic we are discussing today, lender of last resort, both domestically and globally. So what I'm suggesting is I turn to Neha first about broader points on what we have been discussing, and would like to then turn to you and Marcus on how do we think about the role of big tech and the implications on financial stability in particular. So that's the next question for the three of you. But Neha, please.
Yes, thank you, Shayla. So I think sort of 2 points I want to make on this topic of smart regulation and sort of how to think about regulating these new things. So first of all, I think we know quite a bit about the financial risks with some of these new technologies. So, with stablecoins, for example, is a stablecoin fully backed? What is it backed by? And what might the risk be if that stablecoin needs to be unwound at a very high speed? If there's a large number of redemptions, what could that do to certain markets? What I haven't heard as much conversation about, which concerns me a little bit, is the new technical risk introduced by this technology. So I think it's important to note that stablecoins do not operate on traditional financial infrastructure. They operate on top of public blockchains, public decentralized networks. This is very new financial infrastructure that has only existed in some cases for even less than a year with some of these new networks. And what we're seeing is these stablecoins are growing larger and larger and larger on these networks, and people are very focused on the financial risk, but they don't necessarily understand understand all the ways in which these networks might be attacked, or there might be risk with keys getting compromised, or there might be concern about blockchains getting rewritten, or confusion about which is the actual blockchain in some of these networks. So I think this is something that we need to start to begin to discuss, and this is going to require a pretty new skill set in organizations like yours, Jayla, where you have the ability to understand the risks inherent in these different blockchain networks, especially the newer ones, and to advise emerging markets in particular, who are, what I've been noticing is that a lot of these networks are approaching small countries and offering to do pilots. So, understanding these risks and understanding what that might entail, I think, is going to require a new type of knowledge in the global financial system. And I'll pause there. On the notion of big tech, I think I'm very interested to hear what Marcus and Yoon have to say.
Yeah, very good points, Nia. And networks, interlinkages among networks, and potential spillovers and risks among networks are also very important. And I don't think we have a good understanding of that either. And very much take the point that we as an institution also need to upgrade our skills, understanding better some of these issues, and some of the concepts on network spillovers and interlinkages that we really looked at a lot in the past. How do these change in this new framework is going to be really critical. So Marcus, your thoughts on this issue, which is very important one, as well as on the role of big tech and how we need to think through it.
So I agree with Nia that there's a lot of operational risk as well in the private currencies, and that's actually one of the handicaps that these new currencies have, and they probably would like to have some regulation and some stamp from the official authorities. This is actually working well, and there has to be some expertise developed in-house within the fund and also within national central banks and so forth to grant the stamp. But of course, by granting a stamp, you also implicitly grant a certain form of support, so crisis support, and that's will then establish certain stablecoins more than other stablecoins, and that can make certain stablecoins more attractive or less attractive. And I think that's one has to be careful as well to what extent one wants to bring them in the room, and if he wants to bring them in the room of regulation very tightly, then it will be more attractive. It's a little bit like, if you look at the money market funds, they have certain regulation, they have this breaking the buck rule, and because of the breaking the buck rule, they can advertise that, we have actually breaking the buck rule, and they can attract then more investors. And this way, then at the end of the day, you have to provide an implicit guarantee as well. So one has to keep these considerations very well into account, take them into account as well. But in the bigger realm of things, I agree that there's a huge operational risk in this space, and that's again why it's also necessary, and it will be very fast, as Nia pointed out as well. And you have to have some fallback option, and for this, a Cbdc would be the fallback option to have a stable core in the digital arena. And that's why I think there's probably, especially for smaller countries, there's no other opportunity, no other way to go than to have their own Cbdc. Overall, just a final thought I would like to convey, and I agree with Yoon that the existing banking system has done some good advancements, but there's so much more to be done, and there's so many more inefficiency in the banking system. If you look at the number of unbanked people, if you look at how long it takes to make an international transaction, so there's so much more to improve on that. And I think that we should be grateful that there's innovation, but any innovation initially comes with certain risks, so we have to contain this risk. But I wouldn't shy away from saying we should actually stop this or slow it down. I think it is actually important that the innovation keeps going, and then we can improve the situation, in particular for the poor people who are unbanked and don't have the access to what's really needed to thrive in our society.
Hyun, what are your thoughts?
Yes, Joanna, so let me address your question earlier about the implications of the entry of big techs into finance for the banking system. And as we well know, the business model of big techs is built around data. data that's generated from the direct interaction of users in their various business lines, social media, e-commerce, etc. And this interaction gives rise to network effects where the more users flock to a particular platform, the more other users are attracted to that platform, and so we have this sort of this snowballing effect. What this means is that these network effects can enable very rapid growth of big tech platforms in finance, and the two big payment providers in China, I think, is a very good example where 10 years ago. They were really nowhere to be seen. They were very small, but within a space of a few years, they have a 94% market share in digital payments. Now, what does this mean for the banking system? Well, the banks, of course, have tremendous advantages in terms of a loyal depositor base. They have soft information on the borrowers, good relationships, very high. Very high reputation, reputational capital, if you like. But I think one issue is that deposits have, this dual character. On the one hand, it's a payments medium where you debit the account of the payer, you credit the account of the receiver. But on the other hand, it's also a way of, it's a funding source. It's a way of funding, lending. And historically, this combination of roles has grown together. And Marcus, in some of his earlier papers, has talked about unbundling some of this. But I think it's that unbundling is going to be probably a long drawn out affair. Now, I think the issue is that the kinds of informational advantages that banks have are being quickly overtaken by big data and being able to pass that data with AI and machine learning and so on, to the extent that big tech companies have, if you like, entered into partnerships with banks, where it's the big tech firms that provide, if you like, the credit analysis, but then the banks provide the funding. And I think that kind of partnership, we have seen in some jurisdictions, probably means that that comparative advantage that banks used to have is probably less so these days. And I think so. When we apply competition rules to the banking sector and data privacy rules, I think this is the kind of thing we should bear in mind, because, as you say, there are broader financial stability implications of the banking sector in some way being displaced. But I think we should be we should think of this more in the holistic context of how will the financial system look like? How will that constellation look like? Yeah, rather than sort of thinking about the banking system and the sort of two-tier payment system as it were being a kind of high state of the kind of epitome of the financial system from which there could be no more progress. I think we should be open to thinking about a reconfiguration as well. Mm-hmm. And as Marcus said, it's very important that the banking sector, that the banks themselves use this as an opportunity to raise their game.
Thank you for that. Very much agreed. And I think this was a really fascinating discussion, and very good points were raised. It really underscores the need for us to engage more with yourselves as we think through what this means for conduct of monetary policy, conduct of macroprudential policies, capital account management issues, and very much important for us at the fund, what does it mean for how the financial system will look like, how the international monetary system will look like. So many issues, and this was really a great way to go into more deeper some of the design issues. I really appreciated many of the issues that you raised, and learned a lot as well, and look forward to continued discussion. Thank you very much to all of you, and look forward to continued engagement. Thanks again.